Recognize these companies? Sure. In fact, you probably know most or all of them, right? But do you know how these companies are related? These are currently the 30 stocks that make up the Dow Jones Industrial Average. The Dow, as it's nicknamed, is the most often quoted index when we want to know if the market is up or down. And it's just made up of these 30 companies. The other thing that these companies have in common is that they are publicly traded, meaning they are all corporations that issue stock that is then made available to the public through an open market exchange. Hard to believe that we often look at the average of just 30 stocks to gauge the health of the entire stock market. And even if we use the S&P 500 as our measure, that's still only 500 companies. In reality, there are about 4,000 publicly traded companies in the U.S. Now, if this shows us that we often concentrate on watching just a portion of the market on any given day, here's another interesting statistic. The number of private equity companies is approximately 16,000. There's a much broader opportunity of investments out there to consider. And in addition to more opportunities, there is less excess volatility in the privately owned companies that don't trade daily on an open exchange. So let's have a little fun and take a look. The private market may be more familiar to you than you think. Welcome to the RhinoInvestor.com educational series. Like and subscribe to charge along with us. Let's start by looking at a few more companies that you probably know. Guess which ones are private and which ones are public. Play along and let me know your score. These are not recommendations. We're just guessing which company is public and which one is private. Ready? First up, PetSmart and Petco. Staples and Office Depot. Hershey's, which makes Kisses, Kit Kat, Jolly Ranchers, Reese's, and Twizzlers. And Mars makes M&M's, Skittles, Twix, Milky Way, and Snickers. Allstate and Nationwide. Whole Foods and Trader Joe's. H-E-B and Kroger. Taco Bell and Chick-fil-A. SC Johnson, which makes Glade, Windex, Shout, Ziploc, and Off. And Colgate-Palmolive, which makes Colgate and Palmolive, but also Ajax, Soft Soap, and Speed Stick. Archer Daniels Midland and Cargill. Quick Trip and Shell. Schwab and Fidelity. Private companies are often just as well known to us as their publicly traded counterparts. And these are just some names that I grabbed that I felt most of us would know. There are many more companies, both public and private, that we've most likely never heard of. This exercise just shows us that the private market is not as mystical as many of us may have thought. So why would one company decide to go public and another company decide to stay private or go back to being private? Let's look at a few of the reasons a company might make a public or private choice. The advantages to going public may include the following. A company stands to raise a substantial amount of capital by going public. typically more than a private placement. These funds can be used to pay off debt, develop new products, expand into new buildings, advertise, and offer better compensation packages. The advantages to staying private may include less burdensome regulatory requirements, more freedom to choose investors, and ultimately more control over the future of the company and long-term growth strategies versus meeting Wall Street quarterly expectations. When corporations reach a point of being able to raise funds for expansion, it's important to state that each company has its own reasons for choosing a public offering or a private placement. And because the regulatory requirements are not as stringent for private placements, the SEC has maintained that only qualified investors or institutions such as banks, mutual funds, pensions, and endowments are allowed to be investors in those private placements. Private markets offer the same variety of conservative and speculative choices as the public markets do. Just like any stock, bond, or mutual fund you might research in the public space, you'll need to make sure the private offering you're considering meets your objectives and tolerance or non-tolerance for risk. Each private investment also has certain tax considerations to review, same as various public investments. Here are the 3 additional items of note to consider, however, when researching private investments. 1. Investment minimums. It's more common for private investments to require high minimum investments, so be sure to ask. 2. Liquidity and holding periods. Since private investments don't trade on public exchanges, you need to understand the buy and sell schedule of what you're researching. Can you buy and sell once a month, once a quarter? Get the schedule so you're not caught off guard. They're all unique. 3. Fees. Private investments typically have placement fees and profit fees in addition to the regular management fees you may be used to with public mutual funds. Make sure you know what those fees are, how they work, and what the expectations are for you to benefit net of those fees. These are not the only questions to ask, but they're a starting point for your additional research. Adding private market investing to your portfolio can offer higher income, more tax efficiency, better growth, and less volatility than having public market investing alone. And only 6% of financial advisors polled said they know about and use alternatives like private investments. So if this is an area you'd like to explore in more detail, email me directly. We have one more video for qualified investors. Keep going and let's learn about structured products and other non-traditional assets and how they may benefit you. See you there.